From the macros now, inflation accelerates to 6.5% in January on an annual basis after cooling for 2 months. This is well above street expectations of 6.1%. Food and cereal inflation are the main culprits. Lata Venkatesh is here with the fine print and the analysis as well. Lata.
Yes, that's right. This 6.52% is a complete shocker. Even the widest range of our, poll responses came nowhere above 6.2%. So this is a complete shocker for us and for the guests whom we spoke with. What is even worse than the 6.52 headline number is the reason for that rise. The reason is food inflation. Food inflation, which came in at 4.19% last month, this month is up 5.92%. So the full 1 percentage point higher. Within food inflation, what is most ubiquitously consumed, cereals, is the biggest culprit. Cereals are up 2.6% month on month and 16.2% year on year. That is perhaps what both economists and the central bank were not prepared for. Other items, protein items like pulses and even more, meat and fish, egg and milk are other products that are up between 8 and 9%, leading to a very strong rise in food inflation. Core inflation, which is largely services, personal services, transport services, recreation services, that lot is also up 6.1% like it was in December, but that's largely on expected lines. What is unexpected is that the Reserve Bank will have to move now very strongly. When the Reserve Bank hiked rates on Feb 8th, the expectation was that they did not guide whether they will rise or whether they will hike again or not hike, because they just wanted to wait and see. But now a large part of the market will expect that the Reserve Bank has to hike rates when they announce the policy in April.
Oh, yes, of course. Lata, thank you so much for all those details. So let's stay with the CPI inflation numbers and listen into some reactions coming in for the data from Rupa Rege, who's the chief economist at L&T Financial Services, and from Aditi Nayyar, who's the chief economist at ICRA.
RBI must have, had some kind of a clue about today's data print, and that's why you see the undertone of the last policy review was very hawkish. And I personally feel they retained that flexibility because they must have sensed this. We cannot be very optimistic about RBI's future actions, and that's why they have retained that flexibility, and nobody can rule out that there could be another rate hike also.
Clearly, the negative shock has come entirely from food. The other items are by and large in line with what we were expecting. Now, in terms of the average for the quarter, we anyways expected Q4 to be very flattish as compared to Q3. So we were puzzled why the RBI, the MPC had reduced their calculation for the current quarter. A lot of the seasonal factors that take the food index down or the food inflation down would ease out from February onwards. So we cannot expect there to be too much of a benefit from lower vegetable prices, for example, going forward.
All right, that is some opinion coming in on the inflation number, but with that, we'll slip into a break.